Case study number 103. This time we get a senior position loan, again, a non-performing loan secured by a piece of vacant land, which you'll see in a minute, that we resolved through a discounted payoff. This was a short sale resolution. So let's look at the general information here, the high level details. This is vacant land, as I mentioned, with delinquent property taxes that represented a partial equity position securing our non-performing senior position loan. Now, as you know from the last case study on a junior lien, we talked about the senior lien in head of us and the status and balance of that senior. But when you're in senior position, you're looking at the tax balance, which is in head of you, and the status and balance of said taxes. So in this case, let's look at the fair market value to start of the vacant land, which was $35,000. There was a delinquent tax balance of $1,200, which left us with partial equity position of $33,800. The reason that was partial equity, as you'll see here, is because the subject UPB, our principal balance, was over $67,000. So when we take the equity in the deal divided by the UPB to calculate the equity coverage, we see that it is about 0.5 or 50% coverage. So we call it partial equity because it's in between 0.25 and 1. If it was less than 0.25, even though there is a slim amount of equity there, we would call it negative equity or underwater. And if it was greater than 1, we would call it full equity. If it equals 1 or it's close to 1, it might be very close to a full equity deal, but just to be on the safe side, we have a little bit of a buffer zone there. Now the CLTV, on the other hand, is the first lien plus the second lien, or in this case, the first lien plus the taxes divided by the fair market value of $35,000. So in this case, it's 196%. So since this is greater than 1, it is underwater. Now, CLTV versus equity coverage didn't mean as much in our last case study because it was full equity any way you slice it. But on this one, we can see from the borrower's perspective and the investor's perspective. So equity coverage is a nice formula to use as an investor because you can see right here that we actually do have $33,000 that's covering our $67,000 balance. So there's still something there. And if we pay less than 50 cents, we're already at a discount just based on the equity in the deal. Now, CLTV, on the other hand, is from the borrower's perspective. And you can see from this calculation that they are very, very underwater. So that absolutely affects how you're going to price the deal and what type of outcome you're going to expect. So let's look a little bit more information here. The cost basis, what we paid for the deal, $9,800, which represented 14.5% of the principal balance. Not that bad. That's a pretty great price when you think about it. However, second liens, when we talk about UPB, it has much more weight than in first liens. When we talk about percentage of UPB on the senior lien side, it's kind of disregarding the equity and the fair market value, which is so much more important when buying senior position loans. As you may know, if you've watched the Be the Bank show or this channel to any length, you know that senior liens more often resolve through the property, whereas junior liens more often resolve through the borrower. So when you resolve through the borrower, the principal balance is the factor, whereas when you resolve through the property value is really the primary factor here. So looking at percentage of fair market value and percentage of equity are very important, especially in senior position loans. So in this case, $9,800 represents 28% of $35,000, and $9,800 represents 28.99% of that $33,800 equity figure. So right from the get-go here, we can see that we're pretty well protected if our fair market value calculation was accurate. If the information we used to evaluate this loan before we purchased it stands up when we start to get into the actual resolution process. So let's actually talk about what happened here. The borrower story. So this one is pretty interesting because it was actually quite a saga. So to begin, our counsel got in touch with the borrower's counsel, and they explained to us that this borrower had already tried to get a deal done with the bank before the loan was charged off, but the bank was unresponsive and uncooperative at the end of the day. So this charge-off happened and the borrowers kind of lost sight of the loan for a couple of years. Charge-off is like a black box that nobody really knows what happens when these big banks put it onto a charge-off balance sheet. There's no way to get a resolution done as the borrower, and this is really where the secondary market comes in, because after these charged-off loans are sold to third parties in the market, then we can start to talk about resolutions, and there's a more entrepreneurial approach to get these deals resolved. So we offered them a pre-approved settlement letter from our attorney to their attorney right from the get-go. We offered a $44,000 settlement. Obviously, we're shooting a little bit high here in case our property value was underestimated. We also said maybe if you want to do a payment plan, we could do a $3,000 down payment plus $531 per month to move forward. Neither of those were pursued by the borrower. They weren't interested at all. So they actually proposed a deed in lieu of foreclosure, or what the council called a friendly foreclosure, which essentially means they'll give us the property back as long as we waive the right to pursue the deficiency balance, which is anything that still is owed, the principal balance minus what we end up selling the property for. But in this case, we really didn't want to take on that responsibility of owning the vacant land, finding a buyer, and selling it ourselves. So we said, no, how about you find a realtor yourself and short sell the property? We'll agree to a discount if you are in good faith trying to find the best possible buyer for this property. So they told us they thought it was about $35,000, which reflected what we thought in the deal. But again, to shoot a little higher, we listed it for $42,000. So a potential buyer called in and he says the property's comps are between $1,000 and $5,000. And he's acting like a big shot, this potential buyer. He says he was with the HSBC loss mitigation team in the 90s. He's done 30 years of real estate and billions of dollars of foreclosures, and he knows the process and what this place is worth. So he, at the end of the day, is gonna give us $3,000 for this piece of vacant land. So we rejected that offer, of course. We thought it was worth substantially more, but we ended up waiting around for over 5 more months to get the realtor to give us a better offer. So finally, out of the blue, it appeared, we get a message from our counsel saying that the opposing counsel has a sale in place for over $40,000. So we're over the moon with that, and it ended up netting us on this one $38,248. So let's talk about the internal rate of return on this one. And the first thing here is to take the total amount collected, that $38,000 minus the $9,800 cost basis, divided by the cost basis, which that formula is pretty simple. You'll recognize it as the ROI, return on investment. But then to calculate the internal rate of return, we just put that into context of the time value of money by taking the months that it took to exit the deal divided by 12 to annualize it. So in this case, that's $38,248 minus $9,800 divided by $9,800 divided by 23 over 12 to put it into context of an annual return. So when we look at that return here, it's over 290% if we had done it in a year. But when you take that 1.92, which is 23 divided by 12, you can see that this turned out to be a 151% internal rate of return. So even though it took almost 2 years, this was enough of a return to have the patience to wait it out and get the best possible price for this property. Now, a few takeaways here because this one was a pretty interesting situation. And the first takeaway that I want to mention is that the patience here was critical. And without having patience on this deal, we could have easily got that $3,000 sale done and ended up kicking ourselves when that guy resold it for $35,000 to $40,000. Now, another takeaway here is to go with the flow. At first, we thought that this borrower would have been a modification or a discounted settlement type of deal. But when we pushed a little bit further, we could see that they didn't really want this property anymore. And as long as we could waive the right to pursue the deficiency judgment, essentially no strings attached to get the short sale done, they would much rather just get rid of the property or deed in lieu it back to us, as it may be in this case. So being flexible and having patience are the main takeaways here. And if you buy right and you properly analyze the deal from the get-go before you even purchase the loan, that your offer is calculated properly, then you can afford to have that patience and to go with the flow to make sure that you're able to get a deal done that works for the borrower and works with you and your investors. So that is it for today's case study. Thanks for watching. You know where to find me. And if you want to see the first 101 case studies that we've done, check out the Be the Bank live show. From here on out, we'll do 1 case study per month on the live show, and then we'll do another case study here as a standalone video. Until next time, I'll be here waiting.